You're about to enjoy AlphaCast episode 4, where I have the absolute pleasure of interviewing champion trader Kevin Davey. He's a champion because he's not just one or two, but three first and second place finishes with multiple triple digit returns in a real money's future trading championship. He's an algorithmic trader with a unique way of pumping out strategies using his strategy factory approach. If you're a trader, and especially if you're an algorithmic trader, you're going to love this one. Everyone, Kevin Davey. Hey, Kevin, pleasure to be here with you today. I'm super excited. As far as I'm concerned, I think you might actually be the most prolific algo trading writer on all of Amazon. Is that correct?
It might be. I don't know, but I guess you're kind of prolific when you start to see other authors on Amazon copy your book covers and try to mimic what you're doing. And I've seen quite a few of that because I'm like, boy, that looks like my cover, and they actually seem to sell pretty well. So
Yeah.
you could be right.
No, that's fantastic. That's fantastic. Well, obviously, for those of you who don't know, Kevin Davey, fantastic algorithmic trader. We're going to get into his background, how he got started, and his advice for new and experienced traders. So with that being said, Kevin, how in the world did you get in the financial markets?
It really started right after college, and probably a lot of people have been down a similar road. I got something through the US mail at the time. Now, today it would probably be like, hey, you get an email or you see a YouTube video, but it was basically an advertisement for this can't miss trading system to trade sugar. And I was hooked. I mean, I saw it and I was like, wow, this makes sense. Even though it was, just all sizzle and there was really no stake there. Uh, that kind of started me and just started me down this road of trading and losing money and trying a different approach and losing money and then doing something else, losing money. And then finally kind of getting to what they call algo trading now, which was systematic trading or mechanical trading back then, and which is just rule-based trading, things like, hey, if it's a 10 bar high breakout, you buy, and if it's a 10 bar low breakout, you sell short, and you put that in a computer and let it tell you how it did. And that kind of just got me down the path, and once I started doing that, I started getting a lot better at it, and here we are.
Perfect. Now, did you ever get into discretionary trading?
Yeah, many a times where I thought, hey, I'll just follow this price action guru who, he does, I remember one in particular did end of day analysis, and boy, he'd hit it all the time. And I was like, wow, this is like the key. And then I went into his live trading room for like a week, and he was like, well, look at this. It may go up from here. It may go down. And you're like, well, wait, it doesn't sound as great as you sound at the end of the day. And I realized that a lot of discretionary trading, there's probably people who can do it really well, but I'm not one of them. And it seemed like I'd buy right at the peak, I'd sell right at the low point, and and then your emotions get involved. So, oh, I'm going to trade double next time to get it back, and you start doing a lot of goofy things. So eventually, I gave it up. I can't say that I'll never try it again because every once in a while I'll probably try something, but for the most part, I just go pure algo trading now.
Yeah, no, that's great. And sort of I like the maybe not the concrete or the fake confidence that you get from a back test, right? It feels to me at least, hey, I've done some rigorous work on this, and I know that discretionary traders they do deep dives and back tests too, but I've always felt like. I guess certain people are drawn to the number side of things, and that was me. Whenever I was doing the discretionary stuff, I sort of ran into the same issues as you, effectively.
Yeah, that's a good point.
And it's funny because, every time I'm talking to a great, algo trader, I can age their experience level by whether they say, algorithmic trading, systematic trading, or mechanical trading.
Yeah.
So there's a few market wizards that, I talk to about this, and they talk about the, mechanical trading. But anyways, speaking of, mechanical trading, when you first got into, the algo trading, uh, did it, how did you get started? Did you find, what your current platform and just start working? Did you find, someone else that was doing it and said, you know what, maybe this is for me because this discretionary stuff isn't working out?
Well, actually, this kind of tells you how old I am, but I started to do a triple moving average crossover system, and I did it with pencil and paper and getting the prices out of, I was living in California at the time, so I think it was either the LA Times or the Orange County Register. And so I'd get the prices and write them down. I had a hand calculator and calculate it all by hand. And I think I read about that in some book or somewhere that, hey, this triple moving average system, hey, it works great. And so that was the first thing I actually did. I didn't actually back test it because I didn't have a computer to back test it with. But I said, hey, I'm going to start doing it because, look at this chart, look at these examples, looks like it works right. I start out with a $5,000 account, and I still remember I was trading, I think it was live hogs at the time. Now they're called lean hogs. And I was taking every signal religiously, and probably like within a week or so, I lost about $1,500 out of my 5,000. I was like, oh man. And then I had the brilliant idea that if what I wasn't doing was working, the exact opposite must work, right?
Mm-hmm.
So then I started fading all those signals. So when there was a like a uptrend type thing, I would go short. And that started to work for maybe a few days, maybe a week. I don't quite remember. But then it hit a big trend in hogs, and of course I was on the wrong side, and there goes another $1,500 or so. So, within a month or a couple weeks, I forget, I was out 50, 60% of my money. And, then I had to take a break from trading again. But that was how it had all started. So I wasn't even back testing in the beginning. And after a little while, then I realized, oh, I should probably be back testing. And I was kind of a do-it-yourselfer back at that point, and I actually programmed some things in. Actually, the language I was using was Fortran, which that was like an old engineering
Yeah.
language, but it did the job, and I was able to create a decent back tester. Of course, I didn't know how to back test. I just knew I should be back testing, and time proved that you got to know how to back test, not only if you can do it. So it took a while for sure.
Yeah, no, that's fantastic. I haven't heard or used Fortran since my old computer science days, so it's
Yeah,
been a while. That's great. Okay,
yeah.
so then you built this the system, and you're saying now, obviously it makes sense to know how to back test, and I guess obviously as we all grow on the maturity curve of back testing expertise, for lack of better terms, what should you have been doing back then that that you should be doing now?
Couple things. One, I had no idea of the costs involved, like with slippage. So, for example, even on the mini S&P, you can pretty much assume that you're going to get a tick slippage uh, every time you go into a trade. At least that's what I assume. Sometimes you don't get it and you get a good price, but a lot of times what your back test would say is, "Hey, I got in at this price, but really you got in that price plus a tick, so you're already down with the mini S&P like 1250 per contract." That was a big thing because what I've found in the years after that is most ideas, whether they're breakout, moving average, whatever, if you don't include trading costs in the calculations, most things work out on balance. They make some money. A moving average system is a great example. But as soon as you include trading costs, then it falls apart. And and a lot of people say, well, hey, that I'll do the reverse, but trading costs work against you no matter which way you're going, and most times that's a killer. So that's one thing. Another thing I really didn't understand, at least as far as programming and making sure it was right, was doing limit orders. So I was like, oh, I don't want slippage, so I'll use limit orders. Well, what a lot of trading software does, and what I was doing at the time was, hey, as soon as my price was hit, I'd assume that limit order was filled, and then the market would take off. I'd be in it. It was all good. But the reality is, most times with limit orders, your price has to be breached before you get in. So let's just say you wanted to buy at 100 or better. Well, the price has got to go down to 99.9 to really guarantee you a fill. It could hit 100 over and over and over, and you might never get filled. And then the market takes off. Guess what? You're not in that trade. So just knowing some of those intricacies of the market and were things when I was backtesting at first I just didn't do. And I'd create systems that would seemingly take advantage of those. And then what ended up happening is it kind of bit me in the long run.
Yeah, no, that's all. Those are all good points. I mean, when you start backtesting, the last thing, and you're trying to develop a strategy, the last thing as a new backtester you're thinking about is frictions and data quality and all these other things that you just assume, oh yeah, these are fine, but we know from experience that it's not necessarily the case.
Right, absolutely.
Okay, so now, Kevin, I know that you've had a few run-ins with an investing championship, and you've done pretty well. Can you give me some insight into what those investment championships were and how you, I guess, masterminded? You got, I think, a top seed, if I recall correctly, right?
Yeah, I actually finished in second place 2 years, and in between, I finished in first place. All those years were over 100% return, and that those performances were what really convinced me that, hey, I might be able to do this full time. And so, to back up a little bit, I was slowly getting better at my trading. I thought I was doing decently, but you're never really sure if you're doing that well. And so I saw this contest out there. It's called the World Cup of Futures Trading. It was the same one that Larry Williams, legendary trader Larry Williams, turned 10,000 into, I think, 1.1 million over the course of a year. So it was real money. It was a long-term contest.
Did he do that during the
And
championship, or
pardon?
did he do that 1,000? I remember that run, but did he do that through the actual championships?
Yeah, he
Oh,
did it. I thought it was in the 80s at some point. And then years later, his daughter, who Michelle Williams, who's actually the Academy Award winning actress, she actually did it, I think, using him as a proxy or as help, and she won it too. So that was kind of interesting. But the one interesting thing that Larry wrote in one of his books about that, he took 10,000 and ended up the year at 1.1 million, but he mentions that he was also at 2 million at one point. So he actually lost about a million. Uh, you know, he still did phenomenally well, but you can get an idea of how much risk he was
sure.
taking on in that contest by doing that. But, uh, so I knew about that contest, and I said, well, that's one way for me to gauge myself against other people. So I kind of took a year and I fake did it, meaning I didn't actually enter it, but I acted like as if I did, and I would have won that year. And I was like, oh man, I should have done it. But how many people go through that and they have this great performance until it becomes real. But that convinced me. I said, okay, I can do it. And so what I decided to do was I said, well, I'm not going to set a goal for winning, because some years the people who'd win had 1,000%. Other years it was 100%, all over. I said, well, I just want to finish in the top three. And so at the time, this is before I entered, I actually went to the people running the contest and say, hey, do you have the top 3 finishers for the past 5 years or whatever? And they gave me the data, and I came to the conclusion that if I hit 100% return in a year, that I should finish in third place or so, or higher. So I said, that's great. That's my goal. So I designed a system that took on a lot of risk, but it could end up with over 100% return. And then that's what I ended up trading. So uh, I think looking back on it, the neat thing wasn't, oh, hey, he got over 100% return. It was more, hey, I have this goal of a certain return. Now I'm going to design some algos to meet that, and then I'll put it into action. Let's see how it does. Because unfortunately, there's so much noise in the markets that you don't know if you're going to actually do that. You could get a run of bad luck, and you get caught in a drawdown and things fall apart. So you can't really have a goal and expect always to meet it. You just put yourself in the best position you can to meet it, and then the market's going to do what it does. And for me, in those cases, I was actually able to reach that goal 3 consecutive years. So that was the neat part about it.
No, that's fantastic. Are you able to dive into maybe not the exact details unless it's an old strategy, but how you actually reverse engineered, hey, this is a target I want to get to. Here's how I think I can meet that. I think that's fascinating.
Well, yeah. So it started with, I said, okay, I just want to be a trend follower, and I want to do a few different markets to kind of be a little diversified. I was starting out with, I think it was a $15,000 account. So I couldn't be in too many markets at the same time, but that was the start. And I picked some markets that I had lower margin requirements. So I could be in maybe 3 or 4 positions at a time. And uh, what I ended up doing was creating a system and then running a lot of simulations and uh, basically saying, okay, well, if this back test holds, I have a pretty good chance of getting over 100% return. Yeah, there's times where you're going to have a huge drawdown, but uh, you should come out on top if you don't get blown out. But that's part of it is, I took the risk on it. I said, well, there's a chance that my account's just going to get blown out, especially when you're going for 100% returns. You can't expect, oh, well, I'm only going to have 5% max drawdown or 10%. I mean, people think that, but
Hmm.
that's not the reality. The reality is you're taking on a lot of risk. And I don't even recall, I think I wrote about it in my first book, but I know I had a pretty big drawdown during that contest. And what ended up in the year I won, what saved me was there was it was 1 or 2 trades. And the one I remember in particular was copper, where I just rode a trend in copper. And without that, I definitely wouldn't have won. But, there's obviously, I mentioned randomness and luck, and that does play a role in some of those things, which once I was done trading contests, I kind of convinced myself, okay, well, I can kind of do this. I tried to eliminate luck and randomness as much as possible, but even today, I still try to do it. It's not that easy to eliminate.
No, no, you can't force your will on the market, although we all wish we could, right?
Yeah, definitely wish we could.
Yeah. Okay. So in regards to your strategy formations, it sounds like to me when you're looking at a strategy, you obviously have a basic premise like a breakout strategy. Then do you optimize parameters over that, or just trying to get an understanding of how whenever you're developing a new system, what are you really thinking about? Are you looking at the data first? Are you theory driven, empirical driven? Just trying to get an understanding of if you're going to go set out to do a new system, how would you build that?
Okay. Well, over the years, this is definitely, my approach has definitely changed, especially just with the computing power that's out there. Uh, Now I tend to be a lot less theoretical, and as far as putting tons of thought into the idea of, okay, well, I'm going to have a breakout, and when it pulls back, then I'm going to do this, and then I'm going to have profit targets here. And that's the way I probably used to think more. But what I found is simplicity usually is a better way to go rather than try to have a system that does everything. And, a lot of people like to have, well, I'll do this in a bear market, this in a bull market. I just try to have some simple rules that work reasonably well over a long period of time. So that includes bull markets, bear markets, flat markets, but it's not necessarily optimized for each one of those. What you want is you want it to perform well in total, and you don't want it to fall apart during any one particular time. But I look at systems now where I can accept flat periods for a long time. That doesn't bother me as much as it used to. But back to the strategy development, what I'll do is I'll create a system with a couple rules. So let's just take a breakout system, just as an example. So you have your breakout length, and maybe I put a stop loss. I have a stop loss in there. That's two different parameters that I could optimize. And usually I like to stick to under 5, let's say. I like to use a lot of times 2 to 4 parameters, and that's all I'll optimize. And I do a walk forward test, which is a way to get out of sample data. I try to do as much testing as you need, but you also want to do as little as possible. And what I mean by that is I don't run a walk forward optimization over all my data, look at the data, and then say, oh, I don't really like this drawdown, or I don't like this part of the equity curve, so I'm going to go and add a filter. I used to do that, and it doesn't work. It'll make a better back test, but that's not the goal. The goal isn't to create something that looks great historically. It's to create something that looks decent historically, but that continues to work about the same in the future. And that's where most people get messed up in backtesting. Because when you think about a backtest, your output is that backtested equity curve. And so it's natural for people to say, well, I want that to look as good as possible. And that's usually the exact wrong thing to think, because you end up adding filters, so adding parameters, over optimizing, curve fitting, doing all these bad things. And it usually takes people a while before they really get that. I can tell people, and probably people listening to this, oh yeah, okay, don't over optimize, but then they'll go off and create backtests and still do it. Mm-hmm. And it's not until you actually put real money to it, to a system that's over optimized, and you watch it just fall in real time, that you really understand it, like, oh, maybe I did something wrong here. But that's kind of, in a nutshell, what my strategy development's about. So I'll get ideas from anywhere, whether it's a book, magazine, internet, YouTube video. I'll just take it and code it up if it's not already coded, and then test it, and then see. And that's the best way. So I don't rely on anybody else to say, well, this works, because there's a lot of people out there that claim their special method works, except when you test it, and usually then it doesn't work.
Yeah, I've found that to be true too, and I think some of it, obviously, I did some back testing on candlestick patterns, and for my YouTube channel, I'll back test whatever. People can ask, hey, back test this or that, and it's interesting that obviously, the information that's passed generation to generation about what works is typically wrong, unfortunately. And that might
Right.
be just because the different markets, but test everything would be my recommendation too. Um,
Yeah, that's the only way you feel confident in it in the long run. That's why it's so hard to test other people's systems,
mhm.
or trade them, um, because you don't know what all went into it. But if you tested it yourself, then you can have confidence, and that helps you to trade that live.
Yeah, yeah, no, that's fantastic. And you're my fourth guest, uh, and you're the third systematic, and all of them had said, over time, they've taken stuff away. The simpler is the better. So my next question to you is, how many different strategies are you test or trading at once? Because usually that's the recommended approach is to have a lot of simple strategies that work together for diverse
Yeah.
returns.
Diversification to me is the biggest thing to the holy grail. I mean, it's really good. Just to give you an example, like today, gold is up a ton. Well, I'm short gold. Whoops. But I have another algo that's long silver. And so, they kind of balance each other out. And that's what diversification helps you avoid some of those drawdowns. And then over time, if you have 10 systems that over time make money, they'll still make money over time, but now they kind of balance each other out with the drawdowns. So that works great. And right now, I'm trading live about 30 or so different strategies in all the major future market sectors, energies, metals, interest rates, and so on. And that's out of a group of about 175 strategies that I have that I could trade. So I have a process to whittle that down every month to say, okay, well, I'm going to trade these the next month, and it seems to work pretty well. Obviously, there's times where I happen to pick the one that starts doing bad, and leave all the good ones on the sidelines. But uh, I have done at times where I've traded as many as, like, I think 70 or 80 systems at one point, and I mean that can be done. You just run into more issues. And that's the one thing about automated trading that a lot of people don't realize. They think, hey, I just set it up, let it run automated, and come back in a week and, look at how my account's bigger. And that would be nice. But, there's just little internet outages. I just had one about a half hour before we're talking where it was like a split second thing. But sometimes that messes up some of your automation. So you got to be able to check it. And there's just a lot of things that can go wrong. So you got to keep on top of it. But again, that kind of goes back to having multiple strategies, is you're not relying on just one. And if that goes bad, you're sunk. Trading 30, hey, some will lose money in any month. I get that. But what you hope is that the ones that make money make enough to carry the rest of them. And a lot of times that does happen.
That's fantastic, and I like the point of you mentioning simple strategies that you can understand. I went down the road of trying to use AI and neural networks to trade, and I eventually got something working. And then what I found out is that like I had no idea what it was doing, so I couldn't like actually have the confidence to keep it going, right? Um,
Oh,
so that's just one of those things where like, people think that, oh yeah, with systematic traders, you can just turn it on and walk away and whatnot. But we still, I don't know, maybe you don't after these years, but I still have, that maybe not as much of the pressures as a discretionary trader, but we're still battling ourselves and the market, right?
yeah. It's funny because I can always tell who's a real automated algo trader. Um, if they say, there's no emotion, go to algo trading, there's no emotions, and you don't have to worry about that. And as soon as they say that, then I know either they're just sim trading, or, they're not trading at all, sim or otherwise, because as long as you have money on the line, you're going to have emotions. And yeah, it's with algos, it's not should I take this trade necessarily, but it'll be things like, oh, should I turn this strategy off because it's lost money the past 6 weeks? And I kind of lost confidence in it. So those become emotional decisions sometimes. And you've got to realize that, hey, as long as you're dealing with money, there's going to be emotions. It's just going to be different than what you're used to if you were like a discretionary trader.
Right.
But yeah, that's kind of an understated part of it. And I think it all goes back, at least my knowledge, back to probably about 10 years ago, maybe a little longer, when Forex was really popular. And a lot of people were doing it with MetaTrader. They talked about these expert advisors and these robots. Oh, just let the robots trade. And I mean, I'd see ads for that everywhere. And they always said, oh, no emotion. You just set it up and let it go. And I can't imagine how many people lost money doing that
Yeah.
because it's just, that's a tough way to go.
Yeah, yeah, it's funny because I feel like I've made every mistake in the book. I mean, my first algorithm ended up becoming so complex and so over-optimized by the end of it, I didn't even remember what it was doing, right? I'm like, oh, this academic paper looks good. I can just do this portfolio after this. Oh, it'll be perfect. And then, like,
Yeah.
at one point, I'm just like, I have no idea what I'm doing. So I had to throw it out. But yeah, it's funny. I think I'm still a few years behind you, but I'm naturally gravitating to the fewer strategies. I mean, more strategies, fewer complexities. Let's put it that way.
Yeah.
One thing that I'm not doing though is I'm predominantly a stock trader. So
Okay.
you do futures. Can you
Yes.
tell me a little bit more about why you selected futures over stocks? And quite frankly, for me, it wasn't a real big thoughtful decision. I started from a valuation perspective and realized valuation and investing. I like the trading more, so that's why I've just always been in the stock market. It wasn't a purposeful decision. How about you and your futures decision?
So there's a couple things with futures. One is just the amount of leverage. Obviously with stocks, you can buy stocks on margin, and so you can get some leverage that way, or you could trade options on stocks and get a lot more leverage. But futures, just the nature of them, hey, they're highly leveraged products, which obviously can work for you because you can start out with smaller accounts, but it can work against you. So, I mentioned today, gold is up. Last time I checked, it was around $35 a contract, which would be $3,500. And to put on a gold contract right now is somewhere around $8,000 in margin, I believe. So right then you could say, wow, I've made 30-40% on my money today, which, most stocks you can't do that. So while it's a double-edged sword, the leverage has always appealed to me. The tax treatment for people in the US for futures is so much simpler than stocks. One, you literally get a statement from your broker at the end of the year with a bottom number, and that's the only number you need to transfer to your tax forms. You don't have to do all the buy and sell and, match everything up. So that's huge. Another part of that is there's what they call 60/40 tax treatment, where instead of, with stocks, if you hold it less than a year, it's considered short-term capital gains, and you got to hold it more than a year for long-term. Well, futures, even if you held it for 1 second, uh, either 60% or 40%, I always get them backwards, but um, a certain percentage is considered long-term capital gains. I mean, for a 1 second trade, it's crazy. So you can really do well tax-wise uh, with futures trading. And then, the big thing I think beyond those is you get to be in different market sectors. So, I mentioned some of them before, but of course I didn't mention ags and softs and currencies. And you can have systems in all those. And you can also be in the stock market because there's stock index futures, and you can have a nice portfolio that's in all these things. Could you do it with stocks? Probably with some ETFs you could now, because there's a lot of more commodity-based ETFs. But I found that in the time I started, that really wasn't a possibility. ETFs weren't even a thing way back then. So the ability to diversify is a lot nicer in futures. And one other thing I'll throw out, which I've seen a lot of people who try to algo trade with stocks, is they tend to bring their biases with them. Meaning, I'm going to create an algo for Amazon. Oh, okay. I wonder what kind of algo it's going to be. It's probably going to be pretty long most of the time for the past 10 years because, frankly, that's what worked. And so, they already know in the back of their head that what has happened, and then they build an algo that just kind of confirms it. So it's not really, a non-biased kind of good algo in that sense. What would be good is you just took a random stock and you had no idea what it is, and you build an algo for that. But most people can't really do that. But you can do that with futures. If I asked you, hey, what's gold done the past 5 years? Or if you asked me that, I'd be like, well, it's probably gone up. It's probably gone down. I don't know. Because those trends in futures tend to be up. There's a lot more up and down motion. And that's actually good for eliminating biases when you're building systems.
That's great. Yeah, I think some good things to think about, especially from the tax treatment. A lot of people don't know that, and obviously the tax man is sometimes not that friendly.
Right.
So any edge you can get there is fantastic. Now, so I guess at this point, you've won the championships, established a name for yourself. I'm not sure exactly when you wrote the books, but you've also started, I think, a community too. I've seen some strategy factory and a community and a lot of people working with you.
Yeah. So what happened was after I'd won the trading contest, I was just kind of off trading on my own, and people would find me, and so that sort of started this little side business. But what happened, it was more than 10 years ago now, but a book publisher, Wiley Publishing, they're a big publisher in financial books. They approached me and said, hey, do you want to write a book? And I thought, oh, okay, well, that's kind of cool. I always wanted to write a book. And then, I felt that way until I wrote it. And then I'm like, oh my gosh, I can't believe I spent all this time writing a book to get like $3 or $4 per book royalties. It's book writing is tough. I guess unless you're a fiction writer that is a bestseller, most people don't make money selling books. But I wrote the book, and then, which really was great because it helped me just put all my thoughts down, and it helped me even refine what I was doing. Because if you have to explain it in a book, you've really got to understand it. And so that helped out a ton. And as part of that, I said, okay, well, I spent all this time writing this book, and now what? And as it turned out, when the book came out, people started coming to me and say, okay, well, I see your book, but I really want to learn one-on-one with you. Or, do you have a class? Do you have a course? And that started what became what I call the Strategy Factory course. And it's a course on building trading systems and a proper way to do it. And the reason I call it a factory is, one, for some of my career, I was in charge of quality assurance for a factory. And so I kind of obviously was on the factory floor a lot. But that's what strategy building is. You take your idea, that's your raw material, and then you bring it in your factory and you run tests on it. That would be like if you had metal and you were running machines to hone the metal and shape the metal. And then at the very end, you come out with a finished product, which is either a strategy or it's junk. And so it's a perfect analogy for how you want to do it, especially if you want to build multiple ones. Because what's a factory do? What's it good at? It's good at building and building and building. And so that name just felt so appropriate to what I was doing because I was just building strategy after strategy after strategy. And that's what I teach in my course. And so now, after doing it for a number of years, we have a community of people. We have a club where people submit strategies, and then I evaluate them in real time. And it's like a 6-month test, so there's no way to cheat. And then if they're good, people share them, which is really cool because I've never seen anybody else share actual strategies that, hey, this has worked the last 6 months, guaranteed because an impartial judge was watching it. And so we just have this whole group of us who just build strategies and share strategies, and so it's worked out pretty well. It's definitely made me a much better trader because people will come to me and say, hey, how do you do this? Can you explain this? And so then I add a new video to the course. And, I actually have one tomorrow. I did, it was last year, I did over 50 million back tests, all kinds of markets, all kinds of strategies. And I analyzed all the data to kind of say, well, what things in back tests help show that a strategy is going to make money in real time. And so now, after all this analysis, I'm sharing this. And a lot of it's what I've already taught people, but there's some new stuff in there that will help people build strategies even faster. So it's kind of neat. It's me teaching, but it's also me learning and getting a lot better as a trader as I go along, so it helps me out too. So it's pretty fun.
Yeah, no, that's fantastic, and I'm getting sort of the same from some of my trader friends. They'll say, "Hey, can you backtest this for me?" It's just on Twitter and whatnot. But it's interesting
Right.
because you notice when you have to do this stuff and then explain it, you at least for me, there's another filter of okay, I have to really be able to explain this in a manner that's not non-techy and how it actually works. So that's great.
Right.
And then in regards to your factory, because I know a little bit about your trading systems, but I think it's important to for traders to understand is what process does each step of the factory for a strategy take? Because I know that you have a pretty rigorous process to identify you're doing walk forward analysis, and a lot of traders should be doing some of these things, but may not know that they exist or just might not know how to do it.
Okay. So my process is 7 or 8 steps. It starts out with goals. You've got to know what you want so that on the back end you can know if you've met your goal or, hey, should I go back to the drawing board and test more? So you've got to know that. Then you've got to have your trading idea. And obviously you want a whole bunch of ideas. You want the stockpile. Hey, I've got all these things I've got to test. So those are kind of preliminary steps just to get things going. Then the next thing I do is one of the things I do, since most strategies fail, it's pretty much a given. No matter what you're going to test, no matter what great idea you think you have, chances are it's not going to work. And it's 99 times out of 100 that's true, or as many, I've done some studies where it's 1 time out of 10,000 it'll work. Something will work. So most of the things you're going to test are garbage. So what you want to do is you want to limit the amount of time you spend on those. So one of the steps I do is I do a quick test with just a couple years of data. And usually doing that quick test, you can not say, oh, this strategy is good, but you can easily say this strategy is probably not good. There's no guarantee. Maybe you picked a 2-year period where the strategy just was bad and everywhere else it made tons of money, but usually not. So that's an important step because it just helps you filter out some of the real bad ones. And then once you think, hey, I sort of have something that works, that's when you do your real testing. And the first one I do is a walk forward optimization. And for those of you who don't know what walk forward optimization is compared to a traditional regular optimization. Don't have time to explain it here, but definitely read up on it, because walk forward is probably second best in my book compared to just trading live. Nothing beats trading live for proving something works, but walk forward is probably the second best thing out there. And then you have things like auto sample testing, and probably the worst, next to not testing at all, is to do an optimized back test. That's usually, don't do that. That's usually pretty bad. So you run this walk forward back test, and obviously there's certain ways to do it. There's certain rules to do it, and you do it over all your historical data. And then, you have an equity curve. Hey, this is what it looks like. Then I do a simulation, a random simulation. It's called Monte Carlo simulation, that takes your trades on your equity curve, scrambles them all up, and gives you some of the probabilities. Like, what's the probability I trade this system and I get blown out if I start with a $5,000 account? Well, that's good to know. And that's what that step does. And it also, there's a number I use in that will tell you if, on a risk-adjusted basis, this strategy is worth trading. Because I've seen strategies that have made tons of money. I mean, I remember building somewhere. I thought, oh, this is the one that's just going to put me into retirement. And then you start to trade it and you realize, oh, this had a lot of risk to it, a lot of drawdown. And it's not really worth trading. It's so risky. So that helps you filter that out. And then the last big test I do before then, I try to put it in a portfolio and see how it fits and do the correlation and everything, is something I call incubation, which is really just watching a strategy in real time. It's really hard to do, though, because everybody develops a system and they immediately want to go trade it because, wow, look how great it looks. Look all the money I'm going to make. I want to start trading this tomorrow. And what this incubation says is, no, don't do that. Wait 6 months or even a year. Just put that strategy on a shelf and then come back and check on it every few months or every month. Really hard to do. But I've surveyed students who, I ask them, does this help you? Because I always want to make sure what I'm teaching helps people. And every time, it's between 85 and 90% of students say that step has definitely saved me money. Because what you end up doing, if you've over-optimized or done something wrong, the strategy usually falls apart in real time. I used to tell people, how do you know if a strategy is good or not? Take your back test, take your equity curve, print it out on a 8.5 by 11 sheet of paper, put it on the wall, 10 feet away from you, okay? And then, as you get some real-time performance for it, add to that equity curve. And if you can tell by looking at the shape of that equity curve where you went live, that's probably a bad thing, because a lot of times it'll be going up, 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 and then as soon as you start, it goes down. Well, that's obvious. But if you can't tell where backtest ended and real live trading began, then that tells you probably have a good system. And that's what this step is all about. It's just about eliminating those common ones that are common mistakes that people make. And if you do that and it passes, are you guaranteed to make money? No. That they say past performance is not indicative of future results for a reason. But your odds go way up when you've, one, have a profitable back test, and two, have one that's worked in real time for 6 months or so, at least 6 months. You'd be much better off. And so once I'm done with that step, like I said, I put it in the portfolio, check correlation. There, you want to make sure it fits. You don't want to trade two strategies that perform exactly the same because, it doesn't give you any diversification. And that's pretty much it. I mean, obviously the steps are pretty simple. It's putting it all together and then actually applying it. That's the hard part. So many people will, I don't need to test this. This was some best-selling author who wrote this great book. So I don't need to test his system. It's got to work. He wouldn't have made a book about it. Yeah, he would have. It's or people. Yeah, now it's more YouTube ads. Well, I saw this YouTube ad that this guy's making $200 a day every day. And he's only taking 2 trades or whatever. Making 50% a week. You got to watch out for that. The people. One thing I've noticed, they fall into the fallacy of they see these outrageous claims, 100% a week, and they'll say, "Well, that's on." They'll know that that's not real. But if I can get just a tenth of that, if I can get 10% a week, that seems reasonable. I'm not being greedy and going for 100%. I'm just going for 10%. I should be able to do that with this approach. And that's where people get messed up because, not only is this person lying about the 100%, he's not making any money with it. It's losing probably. And you do it, you're not going to get 10% of it. You're going to get minus 10% of it, so that's what you got to watch out for because there's just so much misinformation out there. It's ridiculous.
Yeah, it is unfortunate. And you bring up a good point. Backtest everything because people that you think that are trading might not be, right? So
Right.
that's why on this podcast I'm really trying to vet who I bring on, with the track record because for obvious reasons, I think it's important. Now, in regards to backtesting, what tool and all that the system factory, what tool are you using?
So I use TradeStation now. So I mentioned I used to use Fortran. Now I use TradeStation. It's been around for, I want to say like 30 years or so. So some of the things are a little slow, a little dated. It's not necessarily state of the art. A lot of people nowadays are using Python, and I think you can, excuse me, do pretty well with that too. It's not necessarily the tool you use, but what you have to know is how to use it, also how to break it. So I always tell people, your trading software well enough if you know how to trick it. If you know how to create a great looking back test doing something wrong, then you probably know your software well enough. So for example, if you said, hey, create me a great system in TradeStation that's fake, I could probably do it in about 5 minutes and give you this beautiful equity curve. But for people starting out, they might create that equity curve and think it's real. So you've got to know your software well enough to know what's real and fake. But so I've been using TradeStation for almost 20 years, and I haven't seen a need to jump to another piece of software.
And all the members in your community, they're using TradeStation also?
Not necessarily. So the process I teach works with any backtest software as long as you can optimize and do walk forward backtesting. But certain things like the club that we have to standardize it, everybody sends me code in TradeStation, or I help them develop the code in TradeStation because I'm running everything on TradeStation. And I try to make it consistent for everybody. Now, people in Canada, I have some students in Canada. For whatever reason, the Canadian government has a lot of rules for brokers. And so TradeStation, for a while, they were just in Ontario, and now you can't even use TradeStation brokerage in Canada. You can still use their software, but you'd have to pay for it, which a lot of people don't like to do. So those people tend to use multi-charts, which for people who don't know, multi-charts is really, it started off as at least what I heard was a Russian hacker type knockoff of TradeStation, because TradeStation used to be sold, for a certain amount of money, and so these guys just programmed their own backtest software, but use the same language that TradeStation uses to develop strategies. So you can actually take a TradeStation strategy and 90% of the time just plop it into multi-charts and it'll work. So multi-charts is a good tool too. So I do have that. I do use it. I also have NinjaTrader, and I use that not so much for development, but there's a lot of good software out there that you can use.
So great. So anyone that would potentially want to join your membership community, as long as they're a systematic trader and maybe don't mind translating some things or getting some help with translating into TradeStation, can become a member.
Yeah. I mean, that's the easiest way. I mean, the big thing I always tell people, there's a couple requirements. One is you have to have some trading experience to benefit from my class. I don't teach people from the ground up. It would just be overwhelming for them with all this material that I have. And then two, you have to know a trading platform, be familiar with it. And as part of that, so like 2A, know how to program some strategies in it. And of course, the platform you're using should be able to backtest, optimize, do walk forward testing, do that kind of thing. And as long as you have that background, you'd be pretty receptive to all the material and all the ideas I give you. That being said, I offer with my course, TradeStation help. If you have a problem programming something, since I know TradeStation, I can help you. But if you were a NinjaTrader person, I can't help you with that code, or MetaTrader, because I don't know that code. So it ends up, most of my students end up either starting out with TradeStation or moving over to TradeStation.
That makes sense. Perfect. Well, we've only got a few minutes left. It felt like the conversation flew. I guess a lot of great information. Is there any last piece of advice, maybe something that is not well known, or something that you feel is just like, this is really critical for people to understand? I call it the, dropping alpha, right? And then finally, how can people get a hold of you?
Okay. I think the biggest thing nowadays for people to realize is, especially in trading education, is to realize how many fraudsters and scammers are out there. It is incredible. There's actually somebody who is offering a course to people on creating your own trading course. And they sell you this, I don't know how much, $1,000 package to make you a trading guru. And in their information, they actually say, hey, you don't have to be a trader. You don't even have to be a good trader. You don't even have to know anything. And we'll make you so you're a good trading educator. I mean, that's what it's come down to. It's nuts. And so I always tell people to live by the rule. If it looks too good to be true, it probably is. So if you're looking at Twitter, you're looking at YouTube, you're looking at anything, or watching this, and you think, whoa, what he's saying is too good to be true, go with that thought and run that to ground, because most things you're going to hear out there are false. Performance numbers and all kinds of things. And you see this with people getting arrested and getting sued by the government for running scams. So that's something, I think people know it, so it's not necessarily a secret, but people don't realize how prevalent it is. And it's just so much out there. It's tough. And of course, a lot of people come to me and they say, well, hey, I've been scammed before, you're probably a scammer too. I'm like, well, what can I say except look at my stuff and draw your own conclusion, but
Yeah.
that you get lumped in there.
Right.
But that's the way it goes. So for people who want to reach me, if you go to my website, kjtradingsystems.com, you'll see my contact information there. You can also email me directly. I answer all my emails, kdavey@kjtradingsystems.com. I'm on Twitter, kjtrading. It's a good way to get a hold of me. And you can also go to my YouTube channel. I think it's called Algo Trading with Kevin Davey. Or you can just, in the search box on YouTube, just type in Kevin Davey. I think I pop up near the top. And yes, there's a lot of different ways to get a hold of me.
Perfect. And then I'll put all of those in the show notes. So wonderful.
Great.
All right, Kevin, well, I appreciate your time today. It's been an absolute pleasure. Definitely didn't disappoint, and look forward to talking with you again sometime.
All right. Well, great. Thanks for having me on, and thanks to everyone who listened to me ramble on for an hour or so.
All right. Take care, Kevin.
All right.
And that's it for AlphaCast episode 4. I'd like to thank you for tuning in. You can get all of the show notes and my personal takeaways at analyzingalpha.com/podcast.